The most powerful financial institution you never heard of just issued a global warning, and this time they're not being subtle. The Bank for International Settlements, known as the Central Bank of Central Banks, says the global economy is standing at a cliff, and buried inside that report is a scenario the BIS believes could set off the most dangerous financial domino chain in modern history. This isn't just about inflation or interest rates anymore. This is about a system that's quietly destabilizing beneath our feet, with nearly every major economy more exposed than anyone wants to admit. And what comes next might not be recoverable. Let's start with what the BIS is actually saying. They flagged the convergence of risk: debt, demographics, geopolitical fragmentation, persistent inflation, and financial market fragility, all colliding at the same time. In their own words, we are now entering a new phase where the margin for policy error has disappeared. That phrase should terrify anyone holding assets in a developed economy. And here's why. Global debt has now climbed past $315 trillion, a figure that's nearly 340% of global GDP. For every $1 of economic output, the world is carrying over $3 in debt. What makes that dangerous isn't the size of the debt, it's the cost of it. Since 2022, global interest rates have surged at the fastest pace in 4 decades. According to the BIS, the average advanced economy policy rate has climbed to 4.6%, with many central banks now pausing not because inflation is beaten, but because economies are breaking. This creates what the BIS calls a financial vulnerability loop. As rates rise, debt becomes harder to service. As debt stress builds, growth slows. And as growth slows, central banks face a brutal choice: cut rates and risk inflation, or hold the line and risk collapse. Now factor in persistent inflation. Despite the hikes, core inflation remains sticky across most major economies. The U.S. core PCE is still running at 2.7%, above the Federal Reserve's 2% target. In the Eurozone, it's 2.9%. This isn't disinflation, it's entrenchment. That's what sets the trap. And it's not just monetary. The BIS is pointing to fiscal deterioration as the primary accelerant. The United States, for example, is projected to run a $1.9 trillion deficit this year, with over $1 trillion going just to interest on existing debt. In Japan, the debt-to-GDP ratio is above 260%. In the UK, interest payments now outpace defense spending. When debt is this large and interest costs are this high, governments can't stimulate during downturns without risking market confidence. The BIS warns that the era of structural deficits is now permanent, and the bond market is starting to notice. The U.S. 10-year yield is currently sitting around 4.29%. But what matters isn't just the level, it's the direction. Term premiums are rising, meaning investors are demanding more to hold long-term debt. This is where the danger begins. The BIS outlines a hypothetical but increasingly plausible scenario. A large developed nation, such as the U.S. or UK, faces a credibility shock. Investors begin to question their long-term fiscal path. Bond yields spike 100 basis points in a matter of weeks. In that moment, derivative exposure explodes. Globally, the notional value of derivatives exceeds $600 trillion. Interest rate swaps alone account for over $580 trillion. These are positions most investors never see, but they are tightly interlinked across banks, hedge funds, and pension systems. A sudden move in yields would force margin calls that would trigger asset liquidations. Liquidity dries up, and regulators likely won't see the collapse until it's already midair. This is what the BIS fears most. It's the moment the illusion of safety dies, when cash is no longer king, and every asset becomes a liability. What could spark that shift is deceptively small, just a change in perception, a moment of doubt about fiscal solvency. And in a system this leveraged, that's enough to set the avalanche in motion. So how close are we to that tipping point? Just look at the signals. The S&P 500 just closed above 5,550, with the SPY ETF at $614.91. That's an all-time high, even as earnings growth slows and consumer credit delinquencies rise. Gold is holding strong above $3,000 per ounce, with GLD trading at $301.22. It's a clear sign investors are seeking protection. And Bitcoin, long dismissed as speculative, is hovering around $170,500. But this time, it's trading like a macro hedge, not a meme. In a healthy cycle, risk assets rally while safety assets decline. But right now, they're all rising together. That only happens when money is flooding the system defensively, preparing for something most can't see. Globalization is unraveling. Financial flows are now weaponized. And that's where we reach the tipping point. If yields rise too far, too fast, the global margin system will crack. Derivative exposure will become unmanageable. Collateral will vanish. Liquidity will evaporate. And central banks may find their old tools are useless because you can't fix a confidence crisis with a press release. If you want real-time intelligence on what's happening behind the headlines and how to navigate it before the system resets, subscribe now. Because when the next wave hits, those who saw it coming won't just survive, they'll lead. But even beyond the macro risk, the BIS is also drawing attention to structural imbalances that few outside central banking circles are even talking about. One of the most overlooked threats is the growing dependency on short-term funding mechanisms. Large financial institutions, including banks and non-bank lenders, are increasingly reliant on overnight repos and commercial paper markets to stay solvent day-to-day. In a normal environment, this isn't a problem. But if liquidity dries up even briefly, those short-term positions become existential threats. The BIS noted that a disruption in one funding channel can spread within hours, and we've seen this before. Just think back to the repo spike of 2019, or the overnight freezes during the 2008 financial crisis. Today, those same mechanics exist, only now they're larger and faster. Meanwhile, the private credit market has exploded. In the last 5 years alone, it's grown to more than $2.3 trillion globally. But unlike regulated banks, these lenders operate in the shadows without the same capital requirements or transparency. If defaults rise or redemptions spike, that capital can disappear instantly with zero oversight. That's not just a liquidity problem, it's a confidence crisis in the making. The BIS also warns that central banks may soon face political pressure to re-engage in asset purchases, not because markets are collapsing, but because sovereign borrowing needs are so large that the bond market simply can't absorb the supply. This creates a dangerous cycle. Higher debt, higher yields, and renewed inflation, all with less credibility. Much of the financial system runs on collateralized lending, from repo markets to derivatives to money market funds. But as bond values decline and rating downgrades rise, high-quality collateral is becoming scarce. This leads to collateral scarcity, making safe assets harder to lend against. And once that cycle begins, it's nearly impossible to unwind without massive intervention. The BIS says these systemic weak points must be addressed now before it's too late. Here's the real takeaway. The risks are institutional. Trust in central banks is eroding. Political polarization is paralyzing fiscal responses. And globalization, the very system that once allowed for rapid capital flow and coordinated bailouts, is fading. In its place, we have fragmentation, weaponized finance, and reactive policymaking. And that's what makes this moment so dangerous. If you want to stay ahead of these shifts with real-time insight before the next wave hits, make sure you subscribe. Because when the system resets, those who saw it early won't just survive, they'll lead.